In this video, traders, we're going to look at why does earnings seasons matter? Stay tuned. Hey traders, warm welcome to you. Okay, so what is all the hype about earnings season? You might see it, you're kind of watching the media, you're trading away, and all of a sudden everyone says earnings season's well underway and we have this releasing, that releasing, that releasing. What does it matter and why should you care? Well, regardless of what you're trading, it is very, very important. Obviously, if you're trading individual stocks, you want to be aware of the stock that you are trading, whether it has earnings coming out because of that potential gap risk. If you're trading a stock that doesn't have earnings coming out, it's still the earnings of some of the biggest stocks are still going to affect the market in general. Even if you're trading a commodity or even if you're trading a currency, that could still be potentially affected by the overall bullish or bearish nature of earnings season. So regardless of what you trade, it pays to at least be aware when it is. Of course, if you're trading something so far removed, like you're trading GBP, JPY, and you're worried about the Turkish earnings season or the US earnings season, it's going to have less of an impact, right? But you get the point. You still need to be aware of it. But why is it important? What does it matter? So first thing to know is when is it? So it's 4 times a year, so it's every quarter, and it's ultimately when companies are releasing earnings statements. They get conference calls, not conference calls, doing earnings calls. They're releasing how much money they've made. They're releasing all the data that you need to show, not only for the rules of the exchange, but investors also want to see. They want to say, hey, you know what, that looks good, that doesn't look good, whatever. But there's lots of stuff that's released, but it's giving a kind of taking the pulse of the company every quarter. So it lasts several weeks, and normally it's going to be on January, April, July and October. So it's the month after the last quarter, so that makes sense. So finishing the quarter in December, they're going to start releasing the earnings in January. So what are people actually looking for? So now we know why it's important, why it matters, because of the potential movement it can give anything that we're trading. We know when it is. So what do we actually have to look for? So obviously, if we're trading an individual stock, as I alluded to earlier, that gap risk is the most important thing we've got to manage. We don't want to be in a stock that suddenly comes out with earnings and it gaps up or down on us. Fine if we get lucky on it, but we are just putting it down to luck if we're looking for a short-term trade, which we don't really want to do as traders. And the one thing we've got to watch out for is surprises. So surprises is really, as it says, a surprise in earnings, as in, wow, these guys are nowhere near as profitable as people were expecting, which will nearly always result in a gap lower. Could be significant, could be small. It could be stuff like, hey, we're in line with expectations, but we're revising our guidance for future, and that could also affect the stock. You know, people are investing multiple earnings season ahead, and if a company says, you know what, not so sure about the future, we're going to have to guide lower, then that's going to damage people's perception of the stock because they care where it's going to be. They're looking kind of 4 or 5 chess moves ahead. And also, obviously, the current earnings. So any surprises like that, if we get a lot of downside surprises, that could be bearish for the overall market. If it's 1 or 2 scattered here and there, that's business. Business doesn't always go smoothly. A quarter here and there is not a big deal. Then we're looking at the bellwethers. So the big boy stocks that everyone looks at, the kind of the heroes, if you like, of all the market. These are ones that have been going for a long, long time. Want to see how they are performing, the IBM, all this kind of stuff. How are they performing? Are they continually making money? If there's a broad, and this is the theme here, guys, it's the broad feeling. If the broad feeling is, hey, you know what, all these aren't doing so well, so a few more surprises, the bellwethers aren't really making as much, their earnings might well be slowing down, that might be indicative the economy is struggling. It might be a kind of warning sign, and we might see the market decline from that. Vice versa, if we see all the bellwether stocks, and not many surprises to the downside, all the bellwether stocks increasing guidance and doing well and everything's chugging along and it looks like money's flowing in nicely to them, that could be indicative the economy is going to start picking up. The market might start picking up, might see another kind of 3, 4, 5, 6 months worth of growth in the market. Then we're looking at estimates versus real. So, you know, Wall Street analysts or city analysts are going to sit down, they're going to say, hey, we estimate that this is going to happen. And that's really the voting mechanism that the city or the street has got. And that's how the price is almost dictated. So almost agreed, say, hey, it's trading $50 a share, and the most agreed earnings per share is X, right? And that's pretty much, that's what they agree, and that's what the price agrees. So those two will generally match. If we have an unusual earnings per share to the upside or downside, the price is going to be repriced accordingly, because the company has now become significantly less valuable or more valuable. But the important thing is it's against expectations, because don't forget, price is a pure voting machine almost. It's where everyone agrees that that's the valuation. Your buyers and sellers, the majority agree it's that value. If the earnings per share, the earnings change, then the vote may well change, because the expectation, i.e. this part, the estimate, has agreed at this. If the reality is a lot different to the expected, and that's really the key, that will cause the gap. It's not, some people get surprised when earnings are awful and the stock doesn't do anything. It's probably because the expected was that earnings are going to be awful, and the stock had already accounted for that. And that's why we often see that behavior in the market. The market's, you know, has great earnings, everyone thinks it's fantastic, and the stock starts to go down slightly. And that might be because everyone has expected the earnings to be great, and there might be something small in it that's not so great for term of guidance, or it might just be purely profit taking. So it's expected that's the most important thing to look out for. So anyway, guys, why does earnings season matter? It matters because it affects the economy, it affects the productivity, and it affects the profitability of the companies, which could affect your trades and your investments. What we're looking out for is those surprises, the bellwethers, how they're performing, and the estimates versus the reality. Whatever you're doing in the markets, take care. See you in the next one. Keep the risk managed. Bye-bye.